You're looking to buy a RV, like a toy hauler or a travel trailer, a fifth wheel, a motorhome, but you have bad credit. Don't worry, I got you. First, we have to define what they consider bad credit in the RV world. It's different than the car buying world, and it's different than the home buying world. There are three things that they consider. Obviously, credit score, obviously credit history, but the non-obvious is how much credit card usage there is. So let me explain. First off, when it comes to credit score, they divide into two categories: prime or good credit, and subprime or bad credit. Now, don't shoot the messenger on this, but the way an RV loan works and the way a bank looks at an RV loan is if you're a 719 FICO score or less, you are in the subprime category. Now, there are exceptions to that rule, so don't shoot me yet. And I'll cover those exceptions later on in this video. Now, the way the auto world works, and even the mortgage world works, is if you were like a 715 score, you're considered prime credit. What's the difference? Well, the difference to a bank, in theory, is that if you are having economic hard times, you're going to keep the house because you need a place to live. You're going to keep the car because you need something to go to work. So the first thing to go is going to be the toys. Credit history has a lot to do with whether you're a prime or subprime credit customer. Your history, like a bankruptcy, foreclosure, repossession, charge-off, or maybe multiple 30 or 60-day late payments, put you in the subprime category no matter what your credit score is. In the 15 years of doing this, I've seen some cases where someone has an 800 FICO score, but they had a bankruptcy 8 years ago. That puts you, sorry to say, in the subprime category. Now again, there are exceptions to a lot of these rules, which I'm going to cover later on in this video. And the third factor is credit card usage or unsecured debt. Banks look at that very closely. Doesn't matter what your FICO score is. So if you have heavy credit card debt or a lot of unsecured debt, even if you're an 800 FICO, they still put you in the subprime category. The lenders that handle this type of credit have similar guidelines and programs as the prime banks. The main differences are in the terms and the interest rates, as well as how much they'll actually lend you. And that's what we're going to go over next. The amount of money the lender is going to be willing to give you is mainly based off of installment loan history. Meaning this: boat loans, car loans, truck loans, not mortgages, and certainly not credit cards. Here's a great example. If you have a $50,000 credit card limit, but you've only borrowed $10,000 on a car before, they're going to base the dollar amount on the 10 grand, not the $50,000 limit on your credit card. Okay? Now, there's another factor involved in that too. They want to make sure that you've made at least 24 or more payments on that vehicle, whether it's a boat or motorcycle, doesn't matter, to determine what the dollar amount's going to be. So here's a great example, guys. Let's say that you went and bought a $30,000 car back in 2019, and you took a 72-month term on it, and you made every payment until today. Then they're going to probably give you between $35,000 and $50,000 on the RV loan. Let's say, for example, same $30,000 car, but 4 months ago you bought an $80,000 truck. They're still going to base the lending amount on the 30 grand. If you wanted to base it on the $80,000, you have to wait till you've made 2 years of payments. Not 2 years of payments in 1 month, 2 actual years. You made one payment every single month for 24 more months before they'll use that $80,000 loan to determine your loan amount. Now, here's another excellent example. I've seen some exceptions to all this. So let me give you one of the exceptions just as an example. I had a guy that had a $35,000 truck loan, a $40,000 car loan, and a $15,000 lease. And I was able to get him an $80,000 RV loan. How, you wonder? Well, the fact that every single one of those loans were matured, meaning he was paying at least 3 or 4 years on each of those loans already. So the bank was like, well, this guy takes out the loan and actually makes every single payment on time. And even if he paid it off early, they wouldn't have cared. It was a matter of he carried the loans for a certain maturity time. So there are exceptions to the rule, but not very many. Okay. Now, if you have any questions about that, please ask them in the comments section or send me a message through one of my social media accounts that I have linked in the description box below. By the way, if you look in the comments section real quick, if you want to support the channel, there is an Alloy Man link to Amazon on a great cordless that I use to put down all my manual jacks on for all the RVs at the dealership. So you might want to check that out. Might be a great Christmas gift for you. All right. Now, the other factors involved include income and debt to income ratio. All right. Income is really what they call provable income, meaning you make a paycheck, you have a W-2. That's the easiest way to prove it. For us that are self-employed, they want tax returns. Bottom line is, what they want to see is a minimum income of $3,500 a month before taxes, and in conjunction with a 30 to 35% debt to income ratio. This includes your rent. So let's just run through a scenario real quick. Get a piece of paper and a pen out. If you haven't already, take a minute, pause the video, get yourself a piece of paper and a pen. Let's write this out. Let's say you make $5,000 a month. All right. What the bank wants to do is between your rent and all of your bills, like your credit card and car payments, things of that nature, not utility bills, just not grocery bills, just your car loans and your credit card, everything that shows up on your credit report. They want to make sure that you only have $1,500 to $1,800 going out, meaning you only have $1,500 to $1,800 worth of bills. If you make $10,000 provable income a month, they don't want you to have any more than $3,000 to $3,500 going out. In a lot of scenarios, there's people who have joint credit. They're married, they're spouses. They will take in consideration both incomes as well. If you find the information in this video helpful, please make sure you hit the like button and subscribe to the channel. The terms and interest rates of these loans are very simple. First off, the terms are usually 6 years to 15 years. That's right. I said that right. You heard me. 6 years to 15 years. There's no 20-year loans if you have bad credit in this industry. And I did use quotation marks, okay? Now, how that works is if, let's say you're financing less than $15,000, you're probably going to be between 6 and 10 years on the loan. If you're financing $15,000 to, let's say, $50,000, more than likely your term's going to be right around 10 to 12 years. And then if you're financing over $50,000, generally that's when you're going to go 15 years. Now, there are a few programs here and there that differ. For example, there are a couple of lenders that do a 15-year loan if you're financing $25,000 or $30,000. But again, that gives you a general idea of where they're at. Also, the interest rates go from basically 15% all the way up to 20% now. So there are programs at 19.95 and there's programs at 14.95. So that gives you a general range of what the interest rates and the terms are. Now the hardest part about the whole loan process in this, proving your income. Okay, If you're a paycheck employee, you're the easiest person in the world. I'm talking about paycheck employee that has taxes deducted, not a person that gets a 1099, but someone that gets a W-2 when you file your taxes. All you'll need is 2 paycheck stubs. That means your last 2, and then your W-2 for the previous year's income. You don't need your tax returns. But if you're self-employed or you're a 1099 employee, ooh, baby, you're going to need tax returns, okay? And let me explain what they're going to look at. So let's say you got $200,000 in revenue for the entire year. They don't care about that. They want to see all your write-offs. So when they take your tax returns, they're going to look at either line 7 or whatever line that says adjusted gross income. Usually adjusted gross income is what the federal government taxes you on. Most of the time when I get a self-employed person and their tax returns, they usually don't qualify for the loan. Why? Because their adjusted gross income is usually a lot less than what they actually made. Because that's the beauty of being in business for yourself, folks. You want to rather invest your money back in your business and back into yourself than send money to the federal or state government. So I totally get it. I'm not against that at all. But the bank bases it all on that. Now, what they do sometimes is if you have a Schedule C, if you know what that is, or Schedule K, then they will let you add depreciation back in to your income. But again, a lot of times that doesn't qualify. So make sure that you got your taxes all lined up before you're about to buy your RV. So let's say that we're in 2023 right now. So let's say you want to buy an RV in 2024, then you want to make sure 2023 taxes, you show as much income and you pay a lot more tax to the federal government if you don't have very good credit, or plainly just pay cash, right? Okay. Now, last thing for you folks, real quick, last thing. A lot of times with these subprime banks, they want you to have a utility bill. So they want you to have an electric, trash, or water bill that goes to the address that you say is your physical address. Toughest part about full-time RVing is people that want to go live in them because it's cheaper than rent. You got to have an address that you have a utility bill to qualify for the loan initially. They don't take credit card statements. They don't take cable TV, and they don't take internet bills. It has to be hard, like an electric bill, right? Because nobody has, well, not everybody. There's not as many landlines out there as there used to be, right? Mostly everybody has cell phones. Now, for the exceptions to all the rules, you want to basically start by clicking on that video right there. And then if you guys want to get into what full-time RVing is going to be like and how getting that loan is going to be, that video is right there.